So first of all, I'd like to welcome everyone and thank them for joining this Monex webinar. Today we're going to be talking about Nick's outlook for 2026, including covering FX markets and strategies. Nick Rees is our head of macro research at Monex Europe, and myself, Daniel Jack, I'm head of institutional dealing here at Monex. We do have to mention that this webinar is for informational purposes only. I'm sure that you've all heard many things like this before. The disclaimer is there up on screen. I'm not going to labour the point too much and read the whole thing out to you because we'll have everyone dropping off the call in fairly short order. But it is there. We'll leave it there for a few seconds in case you want to just read it. Perfect. So, for those of you that don't know who Monex are and are new to us, then I'd just like to explain a little bit about who we are and what we do. But founded in 1985, the business has been around for 40 years, has great experience in FX hedging across multiple jurisdictions, as you can see on the map. We have global coverage across all major continents. And important to note that foreign exchange is kind of the key area of the business, and we turned over $274 billion in FX turnover last year. We've got over 2,800 employees globally, and that's backed by $15.3 billion in assets. 9 million in transactions and 66,200 plus clients serviced in the last year. So we hope that that demonstrates that we're pretty good at what we do, and you can access those services 24/7 across all of those jurisdictions. So who are we doing this for? It covers a pretty broad spectrum, and we have specialist teams that deal with corporate and institutional clients. On the corporate side, it covers listed companies, multinationals, a lot of importers and exporters, and businesses of all different sizes. On the institutional side, primarily focused on private capital markets. These are typically alternative investment funds and AIFMs, but we cover, again, a pretty broad range of asset classes from private equity, investment funds, financial institutions, other asset managers, venture capital, family offices, sovereign wealth funds, and a few others that aren't there. But again, pretty broad coverage across a wide spectrum.
Perfect, thanks, Dan. Yeah, no, that's a great introduction to Monex, and this is my part to jump in, take over, and talk through very briefly some of the things we saw last year, and importantly, some of the things we think are going to come up in 2026. It is going to be an interesting year, as I suspect, as last one was as well. But very briefly, before we go on to 2026, a quick look back at 2025. I'm sure familiar to everyone, but President Trump has been a revelation for FX markets, and he's provided many of the key themes for us over the past year. So for those of us that joined our previous webinars, you will be familiar with some of what I'm going to show you on the next slide, which primarily concerns our expectations for Trump 2.0. Useful for us to look back and have a think over some of the things that we got right and some of the things we got wrong, because they do very much inform how we're thinking about markets in 2026. So looking back at the start of 2025, we thought tariffs were going to be a big theme, probably a little higher than markets expected, and that would be accompanied by some sticky US inflation driven by those tariffs. The Fed, in turn, would stay on hold for most or all of 2025, in our view, and we were expecting to see continued US exceptionalism, decent growth in the US. Now, that thesis broadly speaking, played out in 2025. The US economy did really grow quite strongly if you strip out some of the initial shock and the initial data distortions due to tariffs. Look under the surface, US growth was actually pretty solid, but this was of course fueled by some really large deficits. What didn't play out though, strong capital inflows into the US. It was a bit more mixed than that, particularly around Liberation Day. And speaking of Liberation Day and tariffs, they were, of course, a big theme. We did see levies on Canada, Mexico, and China, albeit slightly later than we had initially expected. With, of course, those Liberation Day tariffs following later in the year, some of them pared back, but clearly not the exact impact on FX markets that we'd initially looked for. And this was due to the broad-based nature of those tariffs. Going into the year, like many sell-side desks, we'd treated the expectation of US tariffs as a series of bilateral tariffs. Clearly, if you're going to whack everyone at the same time, that has very different currency implications. Moving on to inflation and monetary policy, as I mentioned, we thought US core inflation was going to remain sticky. With those tariffs adding to price pressures, keeping the Fed on hold. That actually played out really well for most of the year, and we were off consensus thinking the Fed was going to stay on hold for some time, but towards year end, that inflation dropped off, the Fed started to cut rates. And then finally, geopolitics, a big theme at the moment. We were looking for elevated geopolitical tensions given Trump's approach to international relations. That has very much been true and a big theme to start this year, and certainly something we think is going to continue as well. Now, what did that do for FX markets? Well, the primary channel here was through the dollar. The dollar failed to find the support we expected from tariffs and traded a significant discount to rate differentials for much of 2025. In fact, if we look back at the first half of last year, the dollar actually performed the worst it had ever performed in the post-Bretton Woods era. Recovered a little bit through the second half of the year, stabilized, end of the year down around 9% if you measure it on the DXY index. But crucially, if you look at the chart there on your right, you'll be able to see what drove this. There's a big discount opened up between the DXY, the broader dollar index, and the weighted yield spread of US Treasuries relative to other developed market peers. This is crucial because what we see not only is this opening up post Liberation Day when there was that big shock, but it then closes into the back end of the year. So that fact that the dollar stabilized really is a little misleading. What we're seeing here is a cushioning of the dollar downside dynamics by that closing yield spread. That has now closed, so we think those underlying dynamics can take over and really drag the dollar lower as we go through 2026. Other significant developments of note in 2025 before we move on to some of the broader macro expectations for the coming year. It wasn't just Trump that drove markets. Crucially, there was a government shutdown. You can blame that on Trump to a certain extent, but the Fed was also cutting rates into the back end of the year, and concerns over Fed independence and the security of Chair Powell's job helps keep the dollar in the spotlight and help keep traders on their toes. 2025 also saw policy easing come to an end across most of the G10, and this we think is important because it means that monetary policy is fading as a theme for FX markets, shifts the focus onto other dynamics. You can probably guess what those are. It's politics, it's fiscal, and it's geopolitics. It's geopolitical shocks. As mentioned, fiscal policy really took over as a bit of a theme, not just in the US and that government shutdown, but also in the Eurozone in 2025. Big shock in March with the announcement of significant spending in the Eurozone and Germany specifically. That helped the euro to outperform last year, and it's something we think is going to be a theme in 2026 as well. Flip side is true for the UK, where we spent most of 2025 worrying what the government was going to do in terms of the autumn budget. Came and went without quite the shock that we thought it was going to be, but still a concern on the horizon. And for Japan specifically right now, with a potential election coming up, fiscal policy very much in theme, and without the relief channel of rates, it puts the yen under pressure. The final point of note, just bringing this all together, and a real point of surprise for us, was that FX volatility sank, particularly over the second half of last year. This is despite Trump, it's despite the geopolitical risks. And it's despite all of these factors that are going on in markets, there's a lot of moving parts, and yet FX volatility, implied volatility, really ground lower without much getting in the way into the back end of the year. And that to us has been very interesting because it's seen the re-engagement with carry trades favored under a low volatility environment, and that has had an impact, knock-on impact on FX markets as well, helping to boost some risk-sensitive high-yielding EM currencies at the expense of lower-yielding currencies, particularly in the G10. So looking ahead to 2026, what are the key themes we're thinking of? Well, we've got a base case for the coming year. These are our conditioning assumptions. On growth, we expect US growth to be pretty strong in Q1. This is supported by some of the tax changes in the US. It's going to be a big tax rebate, and American consumers are going to be able to benefit from this. We think pretty early. That tax window opens up late January. Of course, if you're going to get money back from the government, you're likely to file your taxes early. So we think a lot of the fiscal impetus in the US comes in Q1 alongside some catch-up growth after that government shutdown at the end of last year. What we tend to see here is that when we have government shutdowns, that delays growth, but it doesn't destroy it. So that's all going to come through in Q1. It's going to really impact those GDP figures. Those GDP figures are going to look great. But that fiscal impetus then fades as we go through the rest of the year. So slowing growth in the US is our expectation after a good first quarter. On Europe, a slightly different scenario here. Of course, we had the promise of good growth last year on increased fiscal spending. It never really showed up, and that disappointed markets. But our big call, and if you've read a lot of our research, it's something we've been banging the drum on for some time. Of course, it was never going to. It takes a while for Europeans to spend that money, but you do feel some market impacts immediately through the rates channel. Rates increase, growth slows, disappoints over the summer, but we do now have signs that that is going to come, especially given some of the measures that have recently gone through the German parliament. So we expect that to come through sustainably in 2026, helping support a sustained growth upswing in the Eurozone. So not quite as much of a disappointment this year, we think. And then finally, we also expect to see stimulus in China, fiscal policy helping to support growth, helping them to hit that 5% growth target, which we assume is going to be in place for this year. So you add all this up, slightly more disappointing growth in the US, but better growth and more fiscal support in the Eurozone and China. That to us points to a pretty benign growth environment and slightly better growth than consensus expectations globally. Translating that into inflation and unemployment, we think we're going to see further stabilization in the US. Inflation has clearly been cooling. The labor market, we think, is adding jobs at around the break-even rate. In the Eurozone, we think there's going to be little change. Inflation's back at target, more or less. Core inflation slightly above that, but we don't think there's going to be much change in inflation in the Eurozone to write home about. There are, however, some risks of monetary policy missteps, particularly in the US, given that we think the Fed is not yet done. They still have to nail the landing, and given some of the concerns around the successor to Chair Powell, whose term at the Fed ends in May, there is the risk of a misstep in 2025. In the UK, the challenge here is similar. They are not yet at neutral with bank rates. We think bank rate has to go lower. And clearly, given some of the fiscal challenges on the horizon, the BOE faces some difficulties in making sure they get that policy balance right. And then finally, in Japan, as I mentioned earlier, we have concerns over the fiscal approach of the new Japanese government. Clearly, elections coming as well, but the BOJ is normalizing policy. They are hiking rates, and those rate hikes are going to weigh against what looks to be expansionary policy. Which one of those weighs out without making a mess is going to be a challenge for markets to navigate. Final point on inflation is AI and job losses. This is a big uncertainty. We just don't know what impact AI is going to have. There's some suggestion this is leading to a bifurcation in the labour market, particularly in the US, that's making a mess of the figures. Right now, the aggregate numbers look okay, but dig under the surface, there are some sectoral issues, and that really poses a challenge from a stability perspective, we think. Putting all that all together, this is what central banks are going to face. We think we're going to see further Fed easing from the end of Q2 once Powell is replaced. The Bank of England and the Norges Bank both able to cut again. Inflation in those countries is slowing. both of those central banks not quite back to neutral. The BOE we think will do 3 rate cuts. The Norges Bank, they've signalled 1. We think that's about right. Other G10 central banks, we think they're now on hold for the rest of the year. We're a little skeptical of market pricing, which suggests a rate hike might be possible from the RBA, for example. We'd like to see a more sustained uptick in inflation for that to be our base case. The only central bank we think is going to hike is the BOJ. Given the policy outlook on the fiscal side, we think monetary policy is going to have to try and counteract that with additional hiking. So certainly 1 rate hike, possibly 2, and risks of 3 if the new government really decides to push the boat out and spend a lot of money. Finally, cross-asset assumptions, just worth noting because these do matter for some of our forecasts. WTI crude we expect to remain stable around $60 a barrel, albeit geopolitical risks are a concern there. Precious metals rally that's been a big story at the back end of 2025 and into the start of 2026. We think that peters out. Some support for gold based on fundamentals, central bank buying, for example, but certainly silver we think is gone too high, too far, too fast. And we would expect to see an unwind at some point. Not calling a top yet, that's a dangerous game to play, but clearly a 150% rally over the course of 2025 is aggressive, and that looks rather frothy in our eyes. The final point of note here is rising equity valuations we think are going to come under increased scrutiny in 2026. AI, of course, is a transformational change potentially for markets and for economics, but we just can't make the numbers add up. We went through them over the holidays and they don't make any sense to us. We think markets increasingly come around to that view in the next 3 to 6 months. So we'd expect to see increased skepticism around some of those AI fueled equity rallies. So diving into some of the themes for 2026, geopolitics, of course, going to be a big one with Trump still in the White House. The FX implications we think will be derived through a couple of channels. Some of it is going to be haven demand, relevant for the dollar, the Swiss franc, and possibly the Japanese yen, albeit that would require fiscal policy to take a back seat. But also a couple of other channels as well are relevant here, commodities and risk conditions most notably. Just breaking that down very briefly, we've got the Don Rowe doctrine. That's been a term coined over the past few weeks. We think this implies a more muscular US stance in the Americas. That's a risk for Latin American economies, and we think that has to translate into an FX move as well, with a small but noticeable discount being priced into LATAM FX over the next 6 to 12 months as markets come around to this new brave new world. In the Middle East, of course, in focus this week, conflicts continue to rumble on. We don't think this is going to lead to a sustained impact on oil prices, but we do see the risk of short, sharp, and potentially fairly ugly oil price shocks relevant amongst the G10 for currencies like NOK and for CAD, potentially injecting some volatility there that's worth keeping an eye on. Russia-Ukraine, of course, peace negotiations into the back end of last year appeared to make some progress. A deal we think is coming at some point, and it would boost Eurozone risk specifically. We think noticeable for CE3, but also for the Euro as well. Where we don't think this is going to have perhaps the impacts that some do is on European growth. We don't think European countries are going to go wholesale back to trading, to buying Russian gas. We think they've had their fingers burnt on that already. To go back would be a mistake. So potentially there some growth upside, but maybe overstated amongst consensus. And then finally, conflict over Greenland has been in focus again today. Trump has suggested that he would like to take over Greenland as a matter of US national security. Clearly, raising tensions between the US and Europe is having an impact on Eurodollar. We think this is probably overstated, but we would like to be more confident than that. Right now, we're not. Taiwan, though, is a risk on the horizon as well. China has suggested 2027 would be the year that they would like to be able to pursue military options if they thought it was needed. Of course, not a certainty. We would expect to see preparations ramping up in 2026, making it a market concern. Moving on then to tariffs and trade, US uncertainty continues to loom in the background. We don't think this is going away in 2026, but we do think it takes a slightly different form to 2025. Liberation Day tariffs surprised markets before Trump reversed course. Bond markets turned around and said, no, thank you, we don't like this. And that really forced the administration's hand. But that has implications moving forward in terms of how the administration are going to approach tariffs. We expect to see a more targeted approach, more akin to the bilateral approach to tariffs we expected coming into the year. That is not necessarily going to see a repeat of the dollar sell-off in 2025. But equally, it doesn't leave us confident we're going to see a dollar rally either after markets have had the experience that they've had. So two-sided risk of the dollar on the back of tariffs, but clearly a source of volatility. And that will continue this week when we are expecting a Supreme Court judgment on IEEPA tariffs. We don't know what they're going to say. Ultimately, we think it'll change little, given the administration has other tools to impose levies. But clearly, it is a risk worth watching, and it will be a source of FX volatility as well in the short run. And ultimately, once we zoom out, US tariffs are going to end up much, much higher than they have been at any point in recent decades. As we can see on the right-hand side, we haven't been at levels like this since the end, really, of the Second World War. So historic tariff levels still likely to have an impact that is making its way through markets. And then the final big theme that we want to focus on for 2026 is fiscal policy and growth. This is something we've been thinking about a lot recently, given that most central banks now, in our view, are going to be on hold for an extended period. That should shift the focus for markets onto fiscal policy, and certainly fiscal policy has taken more of a driving role for FX over the past few months. As mentioned earlier, tax rebates are going to boost US GDP in Q1, we think, spending packages in Europe and the Eurozone, providing a more sustainable tailwind. Notably, though, here, the UK and Japan look most at risk from fiscal sustainability concerns. We think there's a real risk that bond markets choose to test one or two countries in 2026, and those are the two that stand out to us in the UK because of the growth concerns stemming from potential tax rises. In Japan, it's simply the massive government debt. And no convincing plan from the government to tackle that. Markets, we think there's plenty of room there for skepticism, and as a result, potentially higher bond yields and steeper curves. So what does that do for our currency calls as we move through 2026? Well, I'm going to focus here on the dollar, the euro, and sterling because those are three of the currencies that I've had the most requests for. Further falls look likely for the dollar in our view as we move into 2026. We're expecting many of the same themes from 2025 to continue to play out as well, largely because the Trump administration is still in place and they show very few signs of changing course. So what does that mean as we go through the year? Once that Q1 growth boost fades, we expect to see long-run growth at or around potential, with modestly supportive fiscal offsetting a drag on confidence from erratic administration policymaking. So roughly netting out there in our view. Further Fed rate cuts should help erode some of the dollar's carry protection as we go through 2026, particularly in the second half of the year. And as I mentioned earlier, we expect 3 rate cuts, probably restarting in June once Powell steps down as Fed chair. Trump's approach to policy, of course, big source of uncertainty in 2026, as it was in 2025. We don't think that's going to lead to permanent scarring, given that we saw that dollar discount close. But clearly, it's happened once; it could happen again, and that's a big concern for traders to be keeping an eye on as we go through the year. So all told, where do we think the dollar, the DXY, is going to trade? We think it sheds 4 to 5% over the course of the year, relative to current spot levels. For the euro, we see the opposite happening. The dollar softening because growth is around potential in the US, but we have other economies catching up, most notably the Eurozone after disappointing in 2025. We saw that traders initially overreacted to those spending commitments, disappointed by the speed of delivery, but more sustainable growth in 2026 should allow traders to re-engage with that uptick in growth in the Eurozone, helping to propel Eurodollar higher. Our base case result sees Eurodollar moving up to 124 by year end, supported by the ECB remaining on hold through much of the year. In fact, through the entirety of the year under our base case forecast. So we're penciling in 124 for Eurodollar over the next 12 months. And then finally, for sterling, we think sterling is going to underperform alongside the dollar. And this is given our big quibbles with the OBR's autumn budget forecasts, which rescued the Chancellor from not having to nod around, announce some big tax rises. We think those forecasts, frankly, are problematic, let's put it that way. We think inflation is going to come in lower. We think unemployment is going to be higher. We've got no idea how they came to the conclusion that the savings rate is going to magically drop halfway through the forecast period. And we also think immigration is going to come in much softer than expected, a point that's been picked up, I know, by a number of media outlets over the past week or so. You add all that up, we think, in line with the recent commentary, her headroom from the budget has already disappeared, further to be challenged by the data of the next few weeks and months. When it comes to those forecasting assumptions, you add all that up, we think we have another year of speculation about fiscal sustainability in the UK yet to come. Given that, we also think the Bank of England is going to be cutting rates somewhat faster and more than markets have presently priced. 3 rate cuts in 2026 is our base case, if our fiscal view plays out. And that should leave both interest rate and growth differentials weighing on sterling over the course of the year, and particularly pronounced in the first half of the year, given what we expect to see as good growth in the US in Q1. So under our base case, we think cable drops to 131 over the first 6 months of the year, and sterling euro, this has been a big call for us for some time, dropping to 108 over the next 12 months or so. So a really decent downside move there for a cross that doesn't tend to move that much. We think there's good reason to think it will over the course of 2026. In terms of other forecasts that I would like to flag here, we're looking for outperformance across the Scandies, particularly from NOK. We think fundamentals in Norway really support a Norwegian krone that's much stronger than expected, and looking for the spillovers from European growth to translate into Scandi outperformance. These countries typically have a positive beta to Eurozone growth shocks, so that leads to some really quite large moves against the dollar under our base case. Similarly, for the Aussie, we think there's going to be spillovers from Chinese growth and base metals that support Aussie outperformance in the course of the coming year. So roughly 8% rally penciled in, we think, as we move through 2026. And then on the flip side, the Japanese yen, we think it's going to be under pressure from elevated concerns in Japan, elevated fiscal concerns in Japan, with rates unavailable as an outlet for those concerns. We think that has to be felt through the Japanese yen. So we see the Japanese yen climbing to around the 160 level against the dollar, with only intervention threats from the BOJ and MOF helping to contain any further weakness. So the Japanese yen really tracking the dollar lower over the course of the next year. Finally, just some risks worth flagging as we start the new year. Geopolitical flare-ups are, of course, hard to predict. We did not go into the Christmas holidays predicting the situation we are seeing in Iran, or indeed the kidnapping of the Venezuelan president. I think this just serves to highlight the uncertainties that are worth bearing in mind from geopolitical risks, especially around the US. Renewed tariff tensions are certainly likely given USMCA renegotiation in 2026, but we think they're going to be more concentrated, also looking at China in that respect as well. But the exact specifics here are going to heavily determine the FX reaction. Outside the US, there is also a chance here that growth could disappoint again. We have repeatedly called for Chinese stimulus to improve growth in China. It has provided temporary sugar rushes, but nothing sustainable. We think it probably will in 2026, but clearly, having been wrong before, our confidence on that is not maybe as high as some of our other calls. And AI, of course, is a big unknown as well, focusing on employment and equities from a markets perspective. Turning just domestically to the US as well, given that is the source of many of the risks for 2026, there is a chance we get a new US government shutdown at the end of this month, and that would intensify the US data quality issues that have haunted traders over the past 3 months or so. We have no idea where the US economy is going. That makes it very hard to work out where to trade, where your trade should be. Clearly, the longer that goes on, the worse that problem gets. And as mentioned earlier, Powell's replacement at the Fed could herald in a more dovish shift. We think that's fairly modest, but risks are it goes further. That would be negative for the dollar and potentially see a rebuilding in risk premia in treasuries. Of course, there are also risks here that growth, inflation rebound. If the Fed does turn overly dovish, that would be a policy mistake in our view. But doesn't mean it won't happen. And saying all that, treasury market panic here, not our base curve. But curve steepening certainly could be disruptive, and we see a realistic prospect that that happens. So adding all that up, we see plenty of sources for volatility, and just linking back to that slide I showed earlier with volatility at lows, close to all-time lows at the end of 2025, we see plenty of catalysts for that to pick up in 2026. Just very little certainty over when those catalysts might play out and which catalysts those will be. So thank you all for listening to that brief overview of 2026 and our expectations for the year. I'm going to hand back to Dan now to give a brief overview of Monex and some FX strategy for the coming year, bearing in mind what I have just said. Dan, I'm going to hand to you.
Thanks, Nick. Super interesting stuff. No doubt people will be keeping a close eye on those forecasts, particularly people in the office that I know have a few side bets with you. So I think it'll be interesting to see how all of those things play out. I'm just going to talk very briefly about some of the themes that Nick's talked about, some of the products and services that we offer, and how they kind of play into how you deal with the strategy and some of the themes that Nick has talked about. So I'm again not trying to teach anyone to suck eggs here, but these are some of the scenarios where people's FX exposure might arise, typically through foreign currency cash flows resulting that as are resultant of the supply chain, earnings and dividends that you have from foreign subsidiaries, foreign currency loans, balance sheet risks, or net asset value that you might have in different currencies. Capital expenditure, for those of you that are going to look to expand globally into 2026. And clearly on the institutional side, we have investment and divestments that occur in different currencies, potentially capital calls in different currencies, and lots of our institutional clients that operate multi-currency share classes that they look to hedge. So the FX products that we offer that help manage some of these risks are typically forwards and non-deliverable forwards. We can offer historic rate rolls, so off-market swaps that effectively allow people to roll positions forward without crystallizing the P&L in those trades. Vanilla options, we have a brilliant option structuring team that can really help people maximize their exposure and take a really balanced view towards hedging. There are lots of structured FX options that are structured with no premiums. So I know one of the things that people always consider or think about is the fact that options come with a cost. That's not always the case. There are also cap loss structures that allow people to cap downside risk of their mark-to-market exposure. There are also outperformance strategies, so things that will give you better rates than where the current spot markets are, and those will allow people to kind of maximize their profit margins. For those of you, particularly relevant for the import-export sector. If we can have the next slide, please. Thank you. So I've gone through some of the products and services that we offer, but just to kind of explain in a little bit more detail what else we do and some of the things that go behind that. We've obviously talked about the FX products, and that you get 24/5 coverage across the globe. We do offer the ability to hedge up to 5 years forward for a lot of our clients, bearing in mind that these are subject to credit and risk approval. Um, and again, for a lot of our institutional clients, we do portfolio share class hedging, balance sheet hedging, and these include different types of rolling hedges as well. Um, Monex acts as a match principal broker, so that means that we sit in between our clients and the street, by which I mean a panel of banks that we face off against, typically tier one banking providers, and there are sort of 8 to 10 key relationships that we have globally with the world's largest FX banks, where you are essentially leveraging our balance sheet and the flow that I mentioned earlier to get access to better rates. It also allows us to be able to balance our books. We don't take proprietary trading risk as a business, so this allows us to kind of balance our book, net things off across different counterparties, and as far as we can, keep that as flat as possible, minimizing any shocks to our business by extreme movements in rates. The service that we provide can be execution only, but we do also have permissions for an advisory service as well. Um, we do offer multi-currency accounts, so the ability to have bank accounts in your own name. They are agency bank accounts provided by one of our key banking relationships. Um, we also have enhanced cash yield solutions, so for people that have spare cash knocking around. Nice problem to have, I know, but we do have solutions that allow people to maximize the cash that they have rather than just utilizing money markets. There are other solutions available that potentially deliver better yields. Um, as part of the banking solution that we offer, we also provide mass payment solutions. So, for those of you that are on a daily, weekly, monthly basis doing multiple payments to tens or even hundreds of suppliers, for our institutional clients, people that are doing mass distributions to investors, we do have a mass payment solutions that allow you to upload these in a single spreadsheet. We will then take care of all of the payments and take all of the hassle away from that for you. So that's particularly useful. This service is a key element to the offering, and we really focus on relationships, both with our clients and with our LPs. And that means that we have dedicated traders that are attached to your accounts. An industry-leading market analysis that was kindly provided by our good Dr. Nick earlier. So you get access to that, and we often do bespoke analysis for people where they have specific scenarios where they want a little bit more color, and Nick is very kindly happy to provide that. All of those services across the world are delivered within the various regulatory frameworks for the relevant jurisdictions. And importantly, we do try to deliver on the service element more so than perhaps our competitors in the banking world, which means that we can get accounts open and ready to trade within 24 hours. Similarly, for people that are looking for credit facilities, again, those can be done within 24 hours as well. My credit team won't thank me for saying that, but they, with a push, and if everyone's suitably motivated, we can get those things done very quickly as well. We're always happy to provide transparency on the pricing, and there's no setup fees, monthly or quarterly retainers, or any other additional fees of that nature. If I can have the next slide, please. Thank you. So I think one of the things I want to talk about sort of with respect to the themes that Nick has talked about is really picking out the key themes from his discourse on what he anticipates for 2026, and then talking about the products and the things that we can do to help mitigate those risks and potentially the things that people need to consider. If I can have the next slide, please. So, um, some of the things that I picked out were that we're going to see a fairly low volatility environment, but high levels of uncertainty. So that's going to be punctuated by geopolitical risks. Um, and I think that does potentially, give the possibility of black swan events, extreme market moves that people need to be aware of. They can either provide opportunities, or can be pretty painful if you don't have a good hedging strategy in place. Fiscal and political drivers are going to dominate, as Nick said, budgets, trade policy. Markets are moving, much more on these things than they typically are on central bank policy, as they did, many years ago. It seems to be much more about what's in vogue, or the current zeitgeist that drives what's happening in markets. We are going to see a more complex dollar outlook, courtesy of Donald Trump and his eccentricities. So I think there's significant structural headwinds that coexist. Um, and with an episodic safe haven strength. I think carry trades, or crowd carry trades, and the risk of reversal there, um, are a theme, certainly for people in the investment sphere. Low volatility supports yield seeking, but positioning is vulnerable to shocks. I think that's going to be key. And resilience over prediction, flexible hedging, strong execution, liquidity access are critical in 2026.
Awesome. Thanks, Dan. Yeah, no, super interesting. And I know we've spoken about this in advance. I do have some questions for you. Before we get to those, I believe some people might be having some issues viewing the presentation. Apologies if you are. We are planning on doing and sending out a recording of this after the fact. So you should, at some point over the next week or so, once we've worked out what the technical issue is, be able to share with you a version of this PowerPoint. So apologies again if you are having issues viewing the presentation. It is a technical issue, we believe. We're not quite sure what is causing it. But for the time being, it'll have to be a call if you can't see it rather than the slide deck. I am going to ask Dan some questions though about what he's seeing from clients and some of the things he's talking about going into the new year. So Dan, first question coming up. Last year, we saw some fairly significant political and geopolitical shocks, and yet FX volatility ended the year near lows, as we mentioned. How did that environment really shape the way corporate and institutional clients were approaching currency risk?
Um, it's a good question. I think it was a slightly counterintuitive year. On the surface, 2025 looked extremely unstable. There was definitely trade tensions, political crisis, government shutdowns. Yet realized and implied FX volatility steadily collapsed as the year progressed. And this did create the temptation for participants to relax their approach to risk management. But for most of our corporate and institutional clients, the takeaway wasn't complacency, but discipline. So low volatility doesn't eliminate FX risk. It simply masks it. And we saw clients focus more on structure, how hedges behave under stress, rather than their headline market moves. For institutions, it meant being more selective about carry and leverage. For corporates, it meant maintaining hedging programs even when spot markets were quiet, recognizing that when shocks can still arrive suddenly and without little warning.
So then the follow-up question, with follow-up volatility still low at the start of 2026, do you think there's a risk of potentially under hedging, and how are you talking to clients about this as we go into the new year?
Um, I think low volatility environments are actually still some of the most effective, or when some of the most effective hedging decisions can be made. When markets are calm, protection is cheaper, particularly within the options market, And structures can be put in place without the pressure of having to react to major headlines. I think we tend to try and advise our clients to think in layers rather than in absolutes, avoiding the idea that hedging is a binary decision. Instead, trying to take a more holistic approach. Many people are staggering hedges in over a time. They use a combination of forwards and optionality to balance cost with flexibility. The goal isn't to predict when the next shock is, but to ensure that, volatility, or if volatility reprices, which history suggests it will, that their balance sheets and cash flows will remain protected.
Awesome. And then I suppose another question, slightly different topic here. It's about monetary policy really fading as a driver for FX markets, political and fiscal developments taking the focus. What does that change in terms of how clients manage their currency exposure?
It's certainly a significant shift. Over the last few years, FX could often be framed around central bank expectations and rate differentials. That framework is clearly a lot less reliable than it once was. Budget negotiations, deficit concerns, elections, trade policy are having a much bigger impact on currencies. We've all seen, the markets react to Donald Trump's tweets quite severely. So, that's clearly a continuing risk for clients. This means that risk management has become much more event driven rather than reacting to data prints, and they're preparing for known political milestones such as budgets, tariff decisions, or treaty reviews, perhaps rather than the traditional sort of central bank meetings. But then stress testing portfolios around different outcomes is key as well. From our perspective, that requires much closer dialogue with our clients to understand what their goals are, more scenario analysis, and the ability to execute efficiently when those political headlines start to hit.
Cool. And you touched there, Dan, on some of the policy uncertainty, particularly stemming from the US, and the trade and fiscal credibility as well. How are you talking to clients with significant dollar exposure about how to navigate what's been much more of a two-way dollar market, both ups and downs?
It's a great question, and one with not a particularly easy answer, sadly, because the dollar is no longer trading on a single narrative. Structurally, there are questions around fiscal stability and sustainability and US exceptionalism, but in the short term, the dollar can still attract safe haven flows, as we've seen, recently with some of the political events in Iran and elsewhere in the world, in Venezuela. Um, but it does create a much more complex environment for anyone with meaningful dollar exposure. We're definitely seeing clients move away from static hedging and more towards dynamic frameworks. For corporates, that typically means separating transactional exposure from longer term balance sheet hedging and treating them differently. For institutional clients, it's about being selective with positioning and recognizing the dollar can weaken and strengthen for very different reasons over a short space of time. And I think that this is really where our options and structuring team come into play, because they can really help people make the most of those changes in the market, giving that level of protection, but also allowing people to make the most of things if they do move in their favor.
And Dan, just building on that theme of uncertainty that we're seeing at the moment, geopolitical risks feel less like isolated shocks and more like a constant backdrop that we're all having to manage, all having to trade against. How does that reality feed into FX risk management for firms that are active around the world?
Well, this is the thing. Geopolitics is no longer a tail risk, and it's part of our baseline risk management assumption. So whether it's trade disruption, regional conflicts, supply chain realignment, these risks don't neatly resolve themselves after a single event. For globally active firms, risk management now means stability. Um, it means thinking about liquidity access during periods of stress, ensuring that hedges remain effective if the markets do gap, and understanding the correlations between currencies and commodities. It also reinforces the importance of having reliable partners for execution and market access when conditions deteriorate. Um, Not just when markets are functioning normally. So I think, being prepared for these eventualities is key.
No, makes sense, makes sense. And maybe a little change in tack here. But carry trades, as I mentioned earlier, have been a focus into the back end of 2025. They've thrived in a low volatility environment, but positioning there looks pretty crowded now. Are you seeing clients reassess this as a risk as 2026 unfolds?
Yeah, I think that this is definitely probably more for our institutional clients. Carry works well until it doesn't. And when volatility rises, those trades can unwind very quickly, and we can see, quite severe market moves off the back of it. While the search for yield is still understandable, I think there's kind of greater awareness now of how asymmetric the risk profile can be. So we're seeing much more focus on downside scenarios, i.e., what happens if volatility spikes, funding currency strengthen or liquidity dries up, and that leads a lot of clients to reduce leverage, diversify exposure, or put in place protection that limits losses if carry trades reverse sharply. Again, I talked earlier about some of the option strategies that we have that where you can cap losses. It's precisely the scenarios where these types of products work really, really well. It's less about kind of abandoning carry altogether, but recognizing where the vulnerabilities in that strategy lie.
And just building on that point, Dan, if volatility does reprice higher, what should corporates and institutions be thinking about in terms of execution and liquidity?
I mean, execution becomes absolutely critical when markets move quickly. Spreads widen, liquidity fragments, pricing can change in seconds. And in those environments, the ability to access deep liquidity and execute efficiently can make a material difference to outcomes, particularly in esoteric currencies. I think for corporates, that's really thinking about certainty, being able to transact when needed without disrupting cash flows or budgets. And for institutions, it's about speed, transparency, and resilience under stress. From a service provider's perspective, I think it reinforces the importance of robust infrastructure, which we continue to invest in, strong counterparty relationships, which we continue to diversify, and experience navigating volatile conditions.
Awesome. And now I've got two more questions, but first one, and it's a bit more of a personal one for us here in London, relevant also for UK corporates. From a UK perspective, are there specific risks or opportunities that you see for sterling-based corporates in 2026?
I think so, because sterling kind of sits at the intersection of many of this year's themes with fiscal credibility, political scrutiny, and the Bank of England that even more may cut even more than the market anticipates, and that combination suggests probably greater periods of volatility, even if the broader FX environment remains calm. So I think sterling is definitely more susceptible to those issues, and I think for UK corporates with international exposure, it makes proactive FX management particularly important. We're seeing clients focus on protecting margins rather than trying to optimize every move in spot. And the priority is resilience, ensuring that kind of big swings in the market don't undermine an otherwise sound, business proposition or business fundamentals.
And then the final question from me, Dan, before we move on to the Q&A. In an environment where markets can appear deceptively calm, as they are now, what distinguishes a strong FX partner for corporate institutional clients?
Uh, the tendency is for people to not do anything when markets are calm, because um, I think it lulls them into a false sense of security, and it's very easy to focus purely on price. I think the real test of any FX provider comes when the conditions change. So insight, communication, relationships that we talked about earlier, Execution quality and reliability all matter far more when volatility rises or liquidity conditions tighten. So for clients, the value lies in having a partner who understands their business, anticipates risks, and help them navigate both quiet markets and periods of stress. So highlighting kind of the importance of those close relationships with our clients again. And in a world where uncertainty is persistent, that combination of market expertise and dependable execution is ultimately what supports positive long-term outcomes.
Perfect, thank you. Now, I did say earlier we do have a Q&A session. I appreciate we are almost at time, so people will start to drop off. But if people do have questions that they would like to ask us, please do drop them in the chat or in the Q&A section that's provided. And we've had one or two questions in advance as well. So I will start with the one question that I've been nagged about all day today by a few people on our trading floor, and that is, how is the South African rand going to trade in 2026? Obviously, spot right now, dollar ZAR is around 16.4, and the ZAR's really been on a tear given the strength of gold, given the unusual amount of domestic political stability in South Africa, and of course the carry trades that we've been talking about, South Africa as South African rand, a high yielding currency. We think those dynamics likely unwind as we go through 2026. So despite the fact we expect the dollar to weaken more broadly, we think dollar ZAR is still going to rise. So rising from 16.4 around spot levels right now, roughly speaking, to around 16.9 by the end of 2026. It's not a massive rise, but it's certainly ZAR underperformance, we think. So that was the one question that I had. As I mentioned, I had briefly been nagged on by our sales floor, but I'm happy to wait another couple of minutes if anyone does want to drop anything in the Q&A. Or if not, we are at time. So I will suggest we leave it there. Of course, if you do want to email us, ask any other questions, that is absolutely fine. You have our email addresses on screen. Please do feel free to reach out if you've got any questions for us after the event. As mentioned earlier, apologies for the technical issues earlier. If you were struggling with technical issues, we're not sure quite what has caused it, but we will try and get some version of this presentation out to everyone, so you can see the lovely work that our head of marketing has put together, rather than just listening to myself and to Dan. Thank you very much, everyone. Have a good rest of the day, and hopefully see you next time.
Thanks everyone for joining.